around that do long-term contracts routinely, that shouldn't be an issue. We also have to have the contract that clearly specifies the rights of the parties. Okay? Who's obligated to pay what and when? The consideration to be exchanged, how much is the contract for? And how is it going to be paid? It may be paid 20% the first year, 40% the second year, 60% the third, whatever the percentages might be. Both parties, all 2 and 3 says is, this is a legitimate contract. Both parties are expected to perform. If you get into a contract where you don't know if whoever's buying the contract from you is actually going to perform, you shouldn't be recognizing the revenue, right, until you get paid. Making sense? So if those conditions aren't met, then companies use the completed contract method, which is no revenue recognized until it's all done. But most of the time, the conditions are met to use percentage of completion. Okay. By the way, we have similar methods and similar criteria under tax for federal income tax purposes. So it works kind of the same way. The IRS, Congress says, we want to tax the revenue as you earn it. We don't want to wait till the contract's done and then tax it, right? We want to get some each year, basically, if you want to look at it the cynical way that I'm looking at it. But it is logical from an accounting standpoint. This is a Dresnak slide. Tried to make it easier for you to kind of work through what's happening here, the procedures, determine the percentage of completion for each year. Again, I've said we're using the cost-to-cost method. Record the actual costs incurred in this new account we're going to use called construction in progress, and record billings. We're going to go into what each of these accounts are as we do the entries. Determine revenue earned each year. Record revenue, expenses, and gross profit. Right? If you've read through the materials and you've worked through the problem with me, if you did it before also, then this is what we're going to be doing. This describes what we're going to be doing. Okay. I'm going to come back to these last couple slides regarding losses as we go through the problem. Do you have any questions at the moment, conceptually, what we're doing here, what's going on, what this is about? We've really got an income statement focus, but we will have, because it's revenue, but we will have some balance sheet issues as well. Okay, so we're going to do problem 18.6. This is going to be our big problem. Then we're going to do a little bit of 18.7, which has one variation that's important. Ready? You ready? Aren't you guys excited? Isn't this better than spring break? Seriously, this is much more fun, right? You were just getting lazy during spring break, sitting back, hanging out, sleeping late, watching TV, doing whatever you want. I'm describing what I was doing. Yeah, surfing, Anyhow, Techstein, March 1st, 2014, contracted to construct a factory building for fabric manufacturing for a total contract price of $8.4 million. I'm writing that here just to make sure you catch that. Total contract price, $8.4 million. How does that relate to the revenue we're going to recognize on this contract? I'm asking the obvious question. This is today's easy participation point.
The number we're going to multiply by percentage.
It's going to be the number we're going to multiply by the percentage, and ultimately it's going to be the total revenue. Right? The 8.4 million is how much revenue we're going to recognize over 3 years. So if you work through the problem and you end up with a revenue amount different from $8.4 million, go back, because that's what we're generating here. By the way, I'm leaving out a lot of stuff that you get into in actual contracts, like change orders. Okay, if you think about what happens, someone agrees to construct something, and as time goes on, they find the quality of the materials may not be right, or it's not meeting the specs, or the buyer wants something a little different. So change orders can come into play, like we're going to change the contract, we're going to change the structure, we're going to change the cost. We're not getting into any of that. We're just getting the basics. Okay. The building was completed by October 31st, 2016. So March 1st, 2014 is when it's being started. October 31st, 16 is when it's being finished. So we're going to have, if we use a calendar year basis, 2014, 15, and 16, we're going to have some accounting for each. Right? Annual contract costs incurred, estimated cost to complete, accumulated buildings are all here. Now I highlighted this, contract costs incurred during the year. So you've got each of the individual years. This is how much was incurred during 2014, during 2015, during 2016. This is how much at the end of each of those years was left to complete. So at the end of 2014, we had spent this much and expected to spend this much more to finish. By the end of 2015, we had spent this much additional. So these two amounts had all been incurred to date, incurred during the year, 2014 and 15 separate. By the end of 2015, the amount we need to spend to finish has gone to here. Okay, that's what's left. Now these are estimates. When you get into this, I had some clients in this field in my heyday many years ago, and when you get into this, coming up with these estimates, being confident in these estimates, right? You're dealing with builders, you're dealing with engineers, you're dealing with architects, depending on what's being done here. There's a lot of uncertainty, right? So the estimates will change. The total cost expected to be incurred will change because no one knows exactly how much it's going to cost to deliver. The billings should make some sense to you. This is when we invoice the customer. And how much we bill each year will be depending on the contract, right? There'll be a formula determination for how much we can bill and how much the customer's expected to pay each year. Here we're just going to get the numbers. Okay? So we're using the percentage of completion method. And again, I'll refer back to these couple slides, or I'll suggest you guys refer back to these couple slides in trying to understand how to do this. This one, which we're going to work through all the details now, and this one, which I prepared to help you figure out the journal entries and the reporting. Okay? So I'm going to jump into my spreadsheet. Textbook has the PDF version. I like my spreadsheet version better, or they're both good to work with together, because you've got all the computations built in and formulas here to show you where each number is coming from. But you have to go through the details, right? You have to pay attention to it. So what I've done here is set up the 3 years. We'll go 1 year at a time. Best way to do things, right? And realistically, we wouldn't know what's going to happen in 2015 and 2016 until those times come along, right? Think about chronologically. As we finish 2014, we do what we need to at the end of 2014, and then we move on to 2015. Sometimes, and some of the things I see you guys do, you don't seem to realize, maybe you just don't think about it, that you wouldn't really know the 2015 and 16 stuff until after 2014 ends and you move in, right? I mean, you move on. So you got to think about where the company is as each thing is happening, in real life. So it says total costs incurred today during the year, $2.8 million. So I'll just refer back a couple times to the problem, but this $2.8 million is coming right from here, right? Costs incurred during the year. And notice here it says cost to complete $3,520,000 at the end of 2014. That's our estimate. So we've got here in 6.4 million is the total estimated cost, including the costs incurred already. Okay? I've used this problem for 3 or 4 semesters, and for some reason people, not everybody, but some people struggle with understanding where the numbers are coming from. I'm trying to walk you through each of the numbers. The 6.4 million, as the formula says, is the 2.88 million plus the 3,520,000 we estimate it's going to take to finish. Okay? So we've got here in this first formula, this first calculation, I should say, costs incurred this year divided by the total estimated cost, which includes this year. Any trouble understanding that? Does it make sense? If you don't understand it, now's the time. I think once you do, you're like, yeah, of course. It's not difficult. Until you do, it's difficult. So just dividing the first number by the second, 45% finished. This is the cost-to-cost method. Costs incurred to date or this year divided by the total estimated cost. That's where the name comes from. And again, there are different methods. I did a lot of defense contracting. One of the accounting firms I worked for, one of the Deloitte offices I worked for, had a lot of defense contract clients. So they had long-term weapon systems and stuff I don't really understand, frankly, in terms of the military substance, as well as commercial jets and things of that nature. And there are different ways the federal government requires this be done, not the cost-to-cost method. So you have to learn these different methods. But this is kind of the fundamental way of doing it. 45% finished at the end of 2014. Notice again, it's a 3-year contract. That's not 1/3 finished. And again, I know some of you will fall into it's 3 years, divide by 3. No, it depends on the costs incurred and the total estimated cost. Okay? The contract price is $8.4 million. At this point, we're 45% finished, so the $3,780,000 here is that $8.4 million times 45%. We're recognizing 45% of the revenue because we estimate 45% of the costs have been incurred. That's matching. Right? We're good? Yeah? You guys looking like that? Yeah. Good. This should be easy. I'm giving you all the tools. It should be easy. You're smart people. This should be easy. Construction costs incurred to date, $2,880,000. Same thing there. Same number. Right? All I did was copy it down. So the gross profit, in parentheses, I would have losses, which we'll get into next year. Gross profit or gross loss for the current year, $900,000. Revenue minus cost. Question? What financial statement will we find revenue and related expenses and gross profit on? Income statement. You guys all know this. So this is going to be our income statement. Right there. And since I just mentioned that, let me scroll down here and confirm it for you. Here it is. Same thing. That's what's going to be on the income statement for this contract. And keep in mind, companies could have 50, 1,000 contracts in process, right? Depending on the size of the company and what they do. They're all going to be combined when you get to the income statement. There's just one contract. Questions? Now the journal entries. This is where it gets fun. It shouldn't be that difficult, but you got a couple of new accounts here. So you have to understand what the new accounts are. So our first entry here is debiting this new account, construction in progress, and crediting miscellaneous. We'll get into what those accounts are. $2,880,000. Those are all the costs incurred this year. Look at that. We know where that came from. Construction in progress is our first big, and there are only a couple new accounts here, but this is the big one. Got to understand how this account works. Construction in progress is like inventory. It's like an inventory account. Construction in progress, like an inventory account. It's not exactly inventory, but it works like an inventory account. Think of it as an inventory account. What's going to go into it, and since it's an inventory account, right, we know how debits and credits work for assets. What's going to go into it is actual costs each year plus actual costs each year plus gross profit each year. Or, on the credit side, gross loss each year. So where, for example, in a given year we have a loss, it's going to be a credit to this side. Okay, so it's like an inventory account. The actual cost part should make sense to you related to inventory. The gross profit part, that is different from inventory outside of this context. So what you've got here in this first entry is we are debiting inventory. For the seller, the company is building this, whatever it is they're building, let's just say it's a building, right? They're building this building, and these are the costs incurred. So for them it's inventory because they're going to sell that building in effect. Okay? The credits here depends on what they spent the money on. Cash, inventory, accounts payable. What they're going to spend the money is on, remember cost accounting? Some of you have taken cost accounting, you've all taken management accounting, right? What are the 3 ways of describing costs that go into making a product?
Raw materials.
Raw materials, or what the books will say is direct materials. Materials? Work in progress is the account that reflects all those things. Work in progress is Alex. Work in progress is like construction in progress. That's a good comparison. It's not exactly the same, but it's similar.